Hi, Milad Reza here, founder of Anchor Wealth Financial Planning in Adelaide. In today's video, we're going to talk about a different superannuation structure in Australia that is available, being a wrap super fund, to what is dominantly held in Australia, which is a master trust structure, and how this superannuation structure can potentially offer you a buffer in case there is a market downturn. What we have in Australia predominantly is what we refer to it as a master trust. And the way it works is if you want to take money out of a master trust superannuation structure, we need to sell what are called units. And units are basically what you own for the amount of funds you have in place. So if you have $200,000 of, say, superannuation, you may have 100 units worth $2,000 each. And the way that works is if you want to take out, say, $60,000, then you need to sell down a certain amount of units in order to meet that drawdown. So what you see, say, if, for an example, if the units were all worth $1,000 and a market crash happens and each unit then becomes $500, for the same amount of drawdown, you will need to sell twice as many units. So what you're exposed to is what we refer to as sequential risk, having to sell when the markets are down. And once these units are sold, they are gone forever. So what you find is that retirees get caught out. They get caught out in this space because they're having to basically draw down to meet their standard of living. However, it is a downturn in the market and they're exposed to this sequential risk. And it is quite detrimental to the preservation of your super fund or your pension account because, like I said, if it's sold, it is gone forever. On the other hand, a wrap superannuation or pension account is structured differently. There is a centralized cash account inside of a wrap super. And what it enables you to do is create potentially a buffer of X amount of dollars sitting inside of the cash account where you draw down from the cash account. And what it means is that your investments sit in the background and you don't need to sell anything in order to take the drawdown that you require for the year. Now, that is if you have built up a certain amount of cash inside of this cash account. By doing some certain planning to make sure when you get to that point, there is enough cash sitting there for you to meet your drawdowns. What this avoids is you being exposed to potentially sequential risk, that is having to sell when the markets are down because your investments are sitting in the background. They're doing what they need to do. If the markets are down, the unit prices are potentially dropped and we don't really want to focus too much on that because if you're holding the same amount of units, if the unit prices do drop for a short amount of time and you don't access those units by selling them, then you have the ability to recover with the market because you haven't sold the units off. However, as I explained in the previous structure, being the more dominant structure in Australia and more common, I should say, you do need to sell your units if there is the need to take funds out of your super environment. So it is where Australians are getting caught out in retirement. It's important to note this because it is one of the most critical factors when we're talking about preserving your superannuation. When we talk about super funds, there is two parts to it. There's the building of super in the accumulation phase. And then when we get to the point where we want to draw funds out, then we're talking about preservation of your funds. And when it comes to preserving your funds, it is vital that you have the ability to avoid sequential risk as much as possible. Again, having to sell when the markets are down. And as the example I gave, if you need to sell down twice as many units to get the same amount of funds out for the year in a regular master trust structure, what you're doing is potentially selling off the farm. And like I said, once the units are gone, they're gone forever. So it is quite important if you haven't dived into this space, if you need a bit more information, there is a link at the bottom that you can talk to one of our advisors in a free 30-minute superannuation video strategy session and basically walk away making an informed decision.